All right, implementing risk. Avoiding ROR, aka risk of ruin. So risk by my definition is any funds you have exposed to potential loss during a trade. Preservation of capital is number one even before making money. Why? Because without capital to deploy, you cannot make money. The name of the game is keeping our risk very small regarding our overall account size on any one given trade, especially when you are first starting out. Imagine walking away for 5 minutes and your stock comes out with bad news and it plummets. You had your whole account tied into that one stock and you've now lost 30% of your account like that. It happens, especially in leverage scenarios. This is unnecessary, foolish, and does very real psychological damage. I know because I've been there. Trading with stop losses. A stop loss is a limit order placed at a specific price level that will automatically close your trade if it gets hit. This is absolutely essential. Know where you are wrong about your trade and make sure you get the heck out whenever it is hit. Log your trades, study the data, and optimize your exits. Remember, our primary goal has to be to live to fight another day. If you lose 50% of your account, you now have to make 100% return to get back to even. Let that sink in. So how much should you risk? So I think you should risk no more than 1% of your equity on each trade. 0.5% is actually more ideal, especially if you are just getting started. If you've been trading for a while and you know your trade data very well and are profitable, then I can see increasing your size beyond 1% incrementally. And I know this seems conservative, and it is. Beyond risking too much financial capital too early in the game, your psyche is also affected in a negative way as well. Remember that fear and greed are amplified with an increase in money on the line. So your decisions should be as close to mechanical as possible, with emotions at an even keel during the duration of the trade, losses being inconsequential. So racking up large losses early in your trading career can damage your psyche and make you fearful of implementing risks, which is a recipe for disaster. All right, simulated account. So these are good for getting a feel for executing on a new platform or testing a new idea or strategy, but that's about it. A simulated account will never be able to replace the experience or the feelings or the emotions that having real money on the line can. Therefore, it doesn't count and is essentially a waste of your time. So spend just enough time getting comfortable setting up all your orders, getting in and out of trades, and then move on. If you're still a bit fearful when starting out with real cash, then continue to lower your size and your risk until you no longer care if you lose. Even risking small amount of money is still a... So it just ends. That's too funny. All right, we're just gonna roll with it. So even risking an amount of small money is still applying real risk to the markets. It's still good practice as compared to a simulated account where there's nothing tied to it. It's very, very easy. A lot of these lessons are exactly that. They're lessons from my experience. They're things that made me struggle a lot longer than I should have. And part of this was starting a simulated account, becoming wildly profitable in that because there is no risk, and thinking that I could just immediately apply that to the markets, and that's just not the way that it works. So anyways, that being said, there's your warning. Spend a little bit of time on it, use it to get comfortable. Like I said, you can set up like automated trading strategies and you can play with it. There's nothing wrong with that. Just know that that's exactly what it is. It's just play. It's not real.